Thanks for that kind introduction, and thanks, Anna, for your nice words about positive money. So there's a proverb which goes that the fish is last to know the water, and I think that people have a little bit of a similar relationship with money. It's all around us. We're kind of swimming in it. It affects every aspect of our lives. It's the reason why we work. It affects our relationships, our communities, and yet there's certain fundamental aspects of money that a lot of us just don't understand. And I want to talk about one of those aspects today, which is where money comes from, and I want to explain how, if we can understand where money comes from and change our money system, then that can help support a fairer and more sustainable economy. So we're going to start with a little quiz. So we've heard some hints about this earlier on, but we'll give it a go. So who do you think makes notes and coins? Any guesses or any answers? The Queen.
Bank of England. But wasn't there a dispute that they were sending it offshore to France?
Yeah, that's great knowledge. So so the coins made by the Royal Mint, the banknotes are made by a contractor from the Bank of England, or that's employed by the Bank of England, which is a French company, also the company that makes, or is going to make the blue passports, or maybe not anymore. But anyway, yeah. So, and what happens if you make your own money, or you make your own pounds? You might get a visit from the.
In Australia, if you've set up yourself in some funny little. I can't remember the word, but there's a prince somebody or other of a province. Prince somebody or other of something. Hutt province has his own. He set it up legally and he's made his own money.
Interesting. So, as far as I'm aware, if you do that in the UK, then you might get the police might take an interest. So, bearing that in mind, do you think the following statement is true or false? Only the government, via the Bank of England or the Royal Mint, has the authority to create money, including coins, notes, and the electronic money in your bank account. Do we feel like that's true or false? Very good. And then another statement. Banks simply act as middlemen, only lending the money that savers and investors have deposited with them? Do we feel like that's true or false? That's okay. So banks take money from savers and lend it out to depositors, to businesses? Only. No. Read it
again.
It was exactly okay. Well, both of those. If you thought that both of those statements were false, then you are better informed than 85% of MPs that we polled. You're better informed than a lot of bankers and financial journalists. And I'll explain that in a little bit more in a minute. So it's important to understand just 3% of the money in circulation is in cash, in physical cash, in notes and coins. The rest exists as bank deposits, which is numbers on a computer screen. They exist only in electronic form. Most of those bank deposits are created by banks when they make loans. And you don't have to take my word for it. This is from the Bank of England in a paper published in 2014. Commercial banks create money in the form of bank deposits by making new loans. When a bank makes a loan, for example, to someone taking out a mortgage to buy a house, it doesn't typically do so by giving them thousands of pounds worth of banknotes. Instead, it credits their bank account with a bank deposit the size of a mortgage. And at that moment, new money is created. So banks have this extraordinary privilege. And how are they using it? In the decade since the financial crisis, 55% of money created by banks in the UK has gone towards mortgage lending, 18.7% to the financial sector, 6% to consumer loans. And meanwhile, just 10% has gone to productive lending to businesses that create jobs, and just 2% went towards public services. So most undergraduate textbooks in economics will say that what banks do is take deposits and lend money to businesses. As a description of banking in modern advanced economies, this is completely mythological. So what are the consequences of banks having this power to create money? First of all, the creation of money by banks pushes up house prices. The more that banks create money for mortgages, the more demand there is, or the more that people have to spend on buying houses, that increases the demand and pushes up house prices. If house prices are higher, people have to borrow more relative to their income, and that increases household debt. In addition, banks lending for credit cards and overdrafts means that people can borrow more, also pushing up household debt. And rising house prices benefit the wealthy because property is primarily concentrated in the hands of the richest. And higher levels of household debt means more interest payments from everyone to the banks, through the banks to the top 10%, increasing inequality even further. And there's a lot of academic evidence to show that high levels of household debt and inequality make us more vulnerable to financial crises. So basically, banks have the power to create money, and from the perspective of the UK economy, they're not doing a very good job of it. They create too much money in the good times. There was too much bank lending, particularly towards mortgages, in the run-up to the financial crisis, and most of the bank lending is in the interest of the wider economy going to the wrong places. Banks aren't alone, though. So in the years after the financial crisis, central banks, the Bank of England, the Federal Reserve, European Central Bank, started creating colossal amounts of electronic money themselves in an effort to keep their economies afloat. And so it's about to get a bit technical, so I hope you'll bear with me. But this is a process called quantitative easing, and it is really, really important to understand if you want to understand what's gone on with the economy in the last 10 years. This involves central banks creating hundreds of billions of new money and putting it into bond markets by using newly created money to purchase bonds. That pushes up the price of bonds as well as other financial assets like stocks and shares. The idea is that this should make everybody feel wealthier so that they spend more. And that's kind of a version of trickle-down economics. But the reality is that ownership of financial assets, of stocks and bonds, is concentrated in the wealthiest people in the population. So just 40% of stock and bond markets, for example, are owned by the wealthiest 5%. On Bank of England estimates, the wealthiest 5% of households has benefited from quantitative easing to the tune of £350,000, but it's done very little for everyone else. If you just imagine if the Chancellor of the Exchequer stood up at the dispatch box and said that he was going to deploy a policy which enriched the top 5% to the tune of hundreds of thousands of pounds while delivering relatively little benefit for the rest of the population, there would be consternation. But when it's central banks, it's a different matter. They're just they've existed outside the public realm up until now. QE put money into the wrong parts of the economy. So while households and businesses were repaying their loans, which means that money was disappearing from the real economy, quantitative easing has been flooding money into financial markets, inflating asset prices, enriching the wealthy, and the hope was that it would trickle down to the rest of the economy. That trickle down hasn't really worked. Theresa May and other politicians like often to say there's no magic money tree, but there is money. It's going to the wrong places. So in fact, we can think about it like there are two magic money trees. There's banks' ability to create money, and there's quantitative easing. There's central banks creating money. We can take back control of the power to create money. We can build we can grow a more democratic and accountable money tree that serves the public interest. And we call this public money creation. So this might sound like hopefully not to the people in this room, but to some people this might sound like a kind of cranky idea, but it actually has a really, really strong academic pedigree. So Lord Adair Turner he used to be the chief regulator of the UK financial system. He agrees with us. He thinks that the Bank of England could create money for the government to spend on public, like infrastructure, a tax cut if you're that way inclined, as a way of boosting people's wealth without needing to pay the debt off later on. Simon Wren-Lewis, he's an economics professor at Oxford University. He says we need to get behind the idea of helicopter money. This is creating money and distributing it to the whole population. He likes the idea of creating money to put towards a national investment bank, for example, that invests in green infrastructure. These ideas, basically, the Bank of England could create money to finance projects in the public interest. So, just to recap, banks create money when they make loans, and most of the money in the modern economy is created this way. The Bank of England has also created £445 billion since 2009 through quantitative easing. Money is not a finite resource in the way that we understand it to be. It can be created by institutions. The problem is that money isn't being created, or the money that is being created is not going to the right places. Currently, the vast majority of money is being created by banks and going into financial assets rather than the real economy. Instead of just making the rich richer, we can and should create money to serve society's needs.